Good evening and welcome to you. I had to move the TikTok live to tonight as I had things on last night, so I do apologize for that. But nice to see you guys coming in. And I'm looking forward to seeing the first question. Dainke and Claudia and Christina and Rashad. Good evening, everybody. I hope that I can be of some service to you tonight and answer some questions that you have. So let it rip. Let's see who's first. Let's see if there's something I can help with. Okay. I love it. Whoever Christina is, I love the fact that you love my life so much. Thank you, Christina. ODEX, hi Corey, is a 5-year fixed investment with 6.2% payout after tax good. Oh no, ODEX, that is absolutely terrible. No, a 5-year fixed investment with 6.2% based on current inflation rates, you are beating inflation, depending on who you listen to, by either 1.2% or only 0.2%. So no, that is absolutely terrible. ODEX, if you have a fixed investment like that, or if you anticipate doing one like that, I would strongly advise you to go and find a different investment. I mean, you can do literally a 5-year fixed deposit at the bank and get a higher return on investment than what you will for that. So no, that's not good. ODEX, find something else. I reckon you can make use of income funds. That's already going to give you like an 8.2% return. You can make use of a medium risk fund. That's going to give you like a 9 to 9.5%. Yes, it's not guaranteed, but definitely better than 6.2. So don't go with that, mate. For sure not. 1234 says 20,000 Rand monthly investment. Which is the best place to invest to get the highest return? So if you're going to invest 20,000 Rand per month, then it's going to depend on how long you are going to be investing it for. I mean, you can invest 20,000 Rand for literally 3 months, or you can do it for 3 years, or you can do it for 30 years. So it depends on where you're going to invest it. So one first has to determine the time frame that you're going to invest it for. Then the next thing is you have to decide on whether you want the money to be liquid or not, meaning that you can get access to it at any time. Third thing is you have to decide how much risk you're willing to take and how aggressive you're willing to invest. Because if you are not willing to go aggressive, you cannot expect to get a good return. Conservative investments normally give, like ODEX's previously, 6% to 9%, but higher risk investments over a long term can get as much as 14%. So then the other thing is that one has to take into consideration is, do you want tax benefits from it? Do you have a retirement annuity, and is there space for retirement annuity? So based on the type of portfolio that you have or profile that you have, which includes your assets, liabilities, your family makeup, financial dependence, a combination of products might also be good. So the long answer is I can't tell you because there's hundreds of different investments. The short answer is if you get financial advice, and you get somebody to do a proper planning session for you, they should be able to give you a good investment or a combination of good investments. What I can tell you is if you're going to invest 20,000 Rand per month, then there is a number of investments or investment companies and investment products that you can use. And because it's such a high monthly investment premium, you can actually get a substantially lower cost on the investment, which will also help with the return to be better. Okay, I hope that's answered it for you. Dahlia says, whoops, Dahlia, there you go. Just a second, Dahlia, let me get you back here. Dalia says, I bought 5 apartments under my name. At first it was just a hobby, but now I want to turn it into a business. Well, Dalia, I'm surprised it's not a business yet. I mean, if you've got 5 apartments, you'd be staying in one. So the other 4, I would assume, you're renting out. And if you did it as a hobby, well, I suppose you've got some money, because most people can't buy that type of property as a hobby. They have to do it basically as either an investment or as a way of life. So meaning making a business out of it. So if you want to turn it into a business, yes, then you must start renting it out. And you have to decide whether you're going to manage it or whether you're going to get a managing agent. All depends also, of course, that you buy it cash, that you bond it. So, number of factors. But yeah, do so. If you've got 5 properties, go and rent it out. Go and make money out of it. Absolutely. Nkunzi says, what is your take on retirement annuity with Sanlam while you are 20 years old? Nkunzi, to be honest with you, it doesn't matter whether it's Sanlam, Old Mutual, or Liberty, or 10X, or Allan Gray. I think it's a brilliant idea if you take out a retirement annuity at the age of 28. The tax benefits you're going to get over the years is going to be great. The tax-free growth you're going to get in the investment is going to be great. The compound growth you're going to get over the long term is going to be great. All you need to do is you need to make sure that the investment that you take, because you're so young, has got the biggest possible equity and global equity exposure. So because of Regulation 28, maximum 75% in equity, of which 45% can be global stocks. If you do that and you invest it for that long period of time until 55 or later, I think you're going to do fantastic. And then, of course, remember, they've also got their bonuses, the wealth bonuses built in. So if you really go into the investment and you stick it out, you get a bonus at the end of the period. They show you the bonus on a year-to-year basis, but it gets allocated to your investment right at maturity. So go for it. Good investment. Hi, Metsu. Christina says, 400K in a 32-day account, will I get better return at the bank? Well, Christina, if it's in a 32-day call account, then it is already at a bank, because that is a product that banks offer as a 32-day call account. Now, if you're going to get better at a bank, it's going to depend on which bank you're with at the moment and the interest rate that you're getting. On normal savings accounts, now, I'm not going to try and make myself out as knowledgeable on bank products, but on normal savings accounts, you will get maybe, let's call it 4% growth. And then as you are willing to invest the money in a fixed type of savings account for a longer period, they normally give you a higher interest rate. So on a 32-day call account, they might say, okay, normal savings is 4%, 32-day call account will give you 4.5%. If you then do a 6-month fixed deposit, they might say, okay, we'll give you 4.75%. And so it goes on. If you do a 5-year one, then they'll say, okay, we'll give you 8.75%. So it just goes on the longer that you're willing to commit the money to that investment. So if you're in a 32-day call account, it is possible that there's other savings accounts that you can get better at the bank. I don't think you're going to get much better. And if you know my stance on bank investments, I believe that one should just have enough money in the bank for emergency funds. If you can invest the money for a longer period of time, then you can do much better when you invested with investment companies. But in your case, if you need access to those funds on short term because you need it for liquidity or emergencies, just go and speak to your bank. I'm sure they will be happy to sit down and discuss options with you and try and get you a better return than what your 32-day call account is giving you. Abel Banda, by the way, taking 2-pot is like losing 4 months of your service. Abel, I can't give you a set figure, but I just, my personal opinion is anybody that takes money from the 2-pot system is plain stupid. because people take the money and they go and spend it on rubbish. Man, I tell you, I have seen horror stories of people buying clothes and shoes and what do you call it? What does women call this thing? Handbags. It's just ridiculous. So yeah, don't draw money from your two-pot system. And I think, to tell the honest truth, it depends on how big your current fund is. Because remember, if you take, last year you could take 30,000, this year you could take 1/3 of whatever you paid in. So depending on how big you take, yeah, I'm sure it could easily take 4 months of your service, maybe even more. So just don't do it, mate. Just don't do it. Quibber says, hi Corey, when will, whoops, there goes Quibber's question. Let me just get Quibber's question back. There we go. Quibber says, hi Quibber's, Corey, when will SAPS members hear about early retirement without penalties as announced by Parliament? I cannot tell you, Quibber's. I honestly can't tell you. These things, they normally talk about a green paper and a white paper. So when it's on Parliament's desk for discussion, it's a green paper. And once it's been written into legislation, once they accepted it and they make it official, then it becomes a white paper. So I can't tell you when that can be expected to happen. We are all waiting in anticipation to see if it's going to happen and when it will happen. Let's see. Dahlia says, yes, I am renting out all of them as I am out of the country now. Oh, Dahlia, well, fantastic. If you're out of the country, that is great. That's a good way of generating an income in South Africa. And I would assume that if you are out of the country, you are working offshore, which means that you are earning an income offshore. It's an excellent way of earning a second income. So if it works for you, Dahlia, fantastic. I'm not the biggest fan of property, as everybody knows. But if it works for you and you get to manage it and you get to get that income, then fantastic. Then you just go for it. Let's see who else we've got here. TJ Milani. What were you talking about retirement? Just missed it. Okay, TJ Milani, one of the people asked if a retirement annuity from the age of 28 at Sanlam is good. And I said, yes, it is, because of all the benefits that you get on a retirement annuity, the tax deductibility, tax-free growth, compound growth, the fact that if you leave it all that time, you will have a wealth bonus at the end of the day. So lots of benefits. And all I said is that the person must make sure that they choose a portfolio, because they're so young, that has got the largest exposure to equity and global equities as allowed by Regulation 28. So it was just a little bit of my opinion on a retirement annuity and if it's good or bad. Junior AR says, hi, if you got gratuity on child pension when you were 18 and didn't apply for annual annuity for 19, will they include the 19 and 20 when you cash out? I'm not sure I understand your question here. Because if you were receiving a pension because of an inheritance, you should not have to apply after the age of 18. You get that annuity or that income up until the date that is specified. So if we're talking GPF, which I think you might be referring to, you should be getting that income until the age of 21, turning on 22. Once they've approved it, you just keep on getting it until the end of that period. There should not be a reason for you to have to reapply for it. So when you say, will they include 19 and 20 when they cash out? I really don't know, because I don't think you can cash out. You get the opportunity at the end of the day to either take the cash as a lump sum that's been calculated, or you have to take the income. But you can't choose to take the income and then later take the cash. So, Junior, I'm not 100% sure I understand what you're talking about, but I hope I addressed the question with my very broad answer. 1234 says, please explain the GPF penalties if you retire at 55 years. Okay, so GPF works on a formula. The formula takes into consideration your last 2 years of income. It takes into consideration the years of service that you have. It even looks at the position that you held when you were with the GPF. They go and they feed all these things into a system, and the system works out the formula that says you're going to get X amount as a lump sum and X amount as a monthly income. So let's say, just to make things easy, that the formula says that you are going to get 1 million rand as a lump sum and you're going to get 10,000 rand a month as an income. Now, if you go at the age of 55, because you're going 5 years earlier, the formula will change. And the formula will now say, okay, we're not going to give you 1 million rand and 10,000. We're going to give you 800,000 and we're going to give you 8,000 rand a month. So now you get 200,000 rand less as a lump sum. And you get 2,000 rand a month less as a monthly income because you're going 5 years earlier. Okay. But now, what they say now is if you apply and if it's approved, you will not be penalized. That means the formula goes and says, okay, the difference between 55 and 60 is that 200,000 plus the 2,000 rand a month. So we have to give you X amount of money to make up for the lump sum and the income that you're going to get less. They calculate that, they approve it, they say they're going to give it to you, and it gets added onto your pension, it gets added onto your lump sum and your monthly income. But they've only calculated the income for the period from 55 to 60. So from the period of 60 until, let's say, you only pass away at 80 or 90, they have not calculated how much less you're going to get an income because you started taking an earlier income. So although you are being compensated for the first 5 years from 55 to 60, and you basically have and feel no penalty then, you then feel the penalty from the age of 60 onwards, because you are still getting the income of 8,000 as the start of income with annual increases, and you're not getting the actual start of income of 10,000. So you are always, after the age of 60, going to get a lesser income than what you would have gotten if you stayed until the age of 60. I hope that makes sense. I've tried to explain this so many times. I hope it makes sense. Okay, who's next? Okay, let me just see here, folks. Okay, there was the penalties. Odex says no bank can give you 6.2% after tax, or am I wrong? And warranty return. No, Odex, banks can give you 6.2% after tax. Remember the tax that you pay on bank investments and on the interest. There's a calculation once again. It's interest tax, which is effective. You're paying tax on the interest, okay? And that interest rate that you pay in tax is on your personal pay-as-you-earn tax rate, so on your own personal tax bracket. So, for the person that invests and they are in a tax bracket of, let's say, 45%, that person, if that person gets a 10% return on their investment in the savings in the bank or on the interest, 45%, 4,000, after 10%, 4.5% is basically going to tax. So they get an effective return of 5.5%. But for the person that's on an 18% tax rate, if now they got 10% return, their effective rate of return is 8.2% because they only pay 18% tax. So it's not to say that you can't get 6.2. I mean, I've seen fixed deposits with 9.25 and 9.5% rates of return, and because of those rates of return, if you are on a lower tax rate, you will get more than 6.2%. But the fact of the matter is, you will always get out less than what they actually tell you is the return. And if you are investing lump sums over a long term, you're going to get definitely less than what you would have gotten through other investments such as endowments and unit trust. Metsi says, well, on pension soon, I want to invest the 1/3 tax-free payout. What is the portfolio to invest in? Metsi, I'm going to tell you exactly the same that I tell everybody. I can't give you an answer. I can't tell you where to invest the money. I can't tell you what portfolio to invest in, because none of us, nobody has got the same financial situation as the next person. So if you get a lump sum and it's only 550,000 Rand, you might need to have that money immediately available for emergencies, whatever the case might be. So you have to put it into a bank account where you know you can draw it if you need it. But somebody else might have 5 million and they've got so much money that they're getting an income from that they won't need that 5 million. So they can go into endowments, unit trust, venture capital. They can do all kinds of things. So even if I want to inform you, Metsi, of where to invest, I cannot until I've actually consulted with you. I need to understand your situation. I need to understand your assets and liabilities, your incomes and your debts. I need to understand your financial situation with regards to financial dependent people. Do you have to leave money behind for people, or don't you have to leave money behind? Do you have to provide income for people, or don't you have to provide income? So Betsy, there's really a lot of questions I first need to ask before I can give you an answer. But the important thing is that you must go and invest that money. That is for sure. Ainley, hi Kunai, what's your take on buying government bonds? Ainley, my personal opinion is I'm not the biggest fan of government bonds. Government bonds, at the end of the day, yes, it's a guaranteed return. They give you a specific percentage, and very often it's higher than what bank savings is. But at the end of the day, government bonds is interest, and therefore you are going to pay tax on it, and therefore you're never going to get what the actual bond rate is that has been given to you. So my personal opinion is government bonds is very good if you want a safe, secure and guaranteed income. But if you want more aggressive growth on your capital and you want to get a good return on investment when it comes to capital growth, then I will not go with government bonds. In the portfolios that we use, you will also see that especially the low risk portfolios that we do, income portfolios, stable funds, balanced funds, in those funds, the portfolio managers make use of government bonds because it's a safe investment and they know that the money is secure or whatever the case might be. But when you go and look at equity funds where the intention is to get good capital growth, you're not going to find government bonds in there. If you're going to find it, it's going to be minimal, like almost nothing. So that's my opinion about it. I'm not the biggest fan of it unless you want guarantees. Constructieboer, what would you say is the best investment to put your money in for retirement? Constructieboer, I think I've answered this about 2 or 3 times tonight. Different questions, but same answer every time. I cannot tell you unless I've consulted with you. For some people, retirement annuities is the best thing since sliced bread. For other people, endowments are better. For other people, unit trust is better. Because I need to do a proper financial planning session with you and find out all your financial information, assets, liabilities, income and expenditure, family situation, beneficiary needs, financial needs, income needs, how much risk can you take, how much risk are you risk averse, etc., etc. So there's really a lot of questions I need to ask. Then I have to do a planning session, and based on what comes out of that, can I only come to you and say, listen, yeah, I think you have to do product A or product B or product C, or maybe even a combination of these products. So as much as I would love to give you a straight answer with regards to this, I can't. It always comes back to you have to do proper financial planning to determine what's going to be the best. Darren says, I've recently taken out a Stanlip account of 100K. Is this a good idea? So Darren, Stanlip has good investments and they've got good portfolios. I mean, the company like Stanlip won't be as big as they are if they do not have good products and portfolios. Now, if the one that you've taken out for yourself is good, I don't know, because all the factors I've just mentioned to the previous person on doing financial advice, I need to look at all those factors before I can tell you what type of portfolio you should be invested in. Okay. Only then can I tell you whether you should be in a conservative, medium risk or high risk investment. But what I can tell you, and this is what I always say to people, even if you don't know what to invest, how to invest, where to invest, as long as you invest, it is fantastic. You're better off than the person next to you that's not investing. I promise you, even if people invest in the worst type of investment that they can for the 30, 40, 50 years, it doesn't matter. That person will still be better off than the person that does not invest. So Darren, the fact that you are investing, absolutely fantastic, brilliant, congratulations. Whether it is a good portfolio, it is a good idea, by the way. In your questions is this a good idea? It is a good idea. Whether it is a good investment and a good portfolio for you, that I can just not tell you. Okay, I hope that helps, Darren. Abel, Korea, I'm 48, I'm planning to retire at 55 years. I won't get pension, will I? Abel, if you retire, do you mean you won't get pension as in you don't have pension at the moment? If you don't have a retirement annuity, pension or provident fund, then yes, you won't get pension. But if you have any of those three, then yes, at 55, you will get pension. But Abel, here's the thing that one must look at. If you're 48 and you don't have a pension now, do you have other assets? Do you have, I don't know, cash investments, properties, businesses, gold coins, diamonds, whatever the case might be? Because if you don't have any of that stuff, if you don't have assets, how do you retire at the age of 55? And what are you going to do at the age of 55? One of the biggest reasons for people dying young is the fact that they retire at the age of 55 because they're tired, they want to go and rest. They go and sit at home, suddenly their body is not active, their mind's not active, and they die. Fact. People don't want to believe it, it's fact. So I can't really give you an answer unless I know your situation, but better just stay. Keep on working, mate. Keep on working. Farmishka, where did you go now? There we go. Farmish Makoti. I would stay far away from Sanlam. Check their pension fund growth, one of the worst. Farmish Makoti. I am afraid to say, sir or madam, I don't think you understand how pension funds work. I don't think you understand how portfolios work. And I think you might have looked at one specific aspect of Sanlam which might not have been performing well. And now you want to advise people to stay away. Don't do that. People should investigate all options. And let me tell you, Sanlam is a good company. They've got good portfolios. I got retirement annuities in our portfolios for clients that is doing very well. Yes, there might be times that it's not doing as well, but that happens with all companies. It's not only limited to one. So no, don't make a comment like this unless you are knowledgeable and educated about the subject, because you scare people off, and it should not be like that. Rather go and get somebody to look at these pension funds and stuff with you, and to give you an informed and a proper answer as to why a specific fund is not doing well. And yes, I do agree. Sometimes there are portfolios of funds that are just horrific, and then one must walk away from them. But it is very seldom, right? It's not very often. So the percentage of portfolios that does not do well in companies is normally very small. So I think you've had a bad experience with one specific fund or so. It's not like that across the board. Across the board, they're actually doing very well. Sanlam better give me some reward for coming up for them tonight. Odex, you're welcome to in. Odex says, thanks, good night. I will contact you. Odex, you are welcome to, sir, madam. As you know, in my WhatsApp profile is my WhatsApp number. Sorry, I've confused myself now. In my TikTok profile is my WhatsApp number. And in my TikTok profile is also my website where my email address is. So yes, contact me on one of those and I will gladly assist you with whatever needs to be helped with. Okay, Metsi, looking forward to it. 1234 says, please share your contact details so I can book an appointment. So just give me a second, yeah? So, Metsi, I can't really type while I'm talking. It gets a bit difficult to scroll, talk, and do that. So what I can tell you is the following. So, first of all, in my profiles, TikTok, Instagram, Facebook, in those profiles is my contact details, okay? So anybody can go to one of those profiles. And folks, I will never contact you first, okay? So you must contact me and then I'll make contact with you and then I'll help you out. But what you can do, I hope you've got a pen and paper or something here. You can write down the following email address. It is talktous@heptagonc.com. talktous@heptagonc.com. And you can send me an email there and I can assist you. Alternatively, my WhatsApp number that you can get hold of me is 060-541-4685. I'll repeat it once more. 060-541-4685. Okay. Hope that helps you. Hope you got the pen and paper quick enough. Kanya says, hi, where can you invest your money besides banks? Kanya, there is multiple places that you can invest your money. I actually made a video once and I just went and looked at the different places that we know of that you can invest. And I made a list of at least 40 different products where people can invest money. There is really so many places. Insurance companies has got bank accounts, unit trust, endowments, bonds, you name it. You can invest in gold, you can invest in diamonds, you can invest in shares, you can invest in alternative investments, livestock funds, entrepreneur funds, arbitrage. The list is endless of where you can invest beside banks. Find yourself a financial advisor that can help you. Find yourself a financial advisor that can give you some good advice and that can give you some good products. I know that not many independent brokerages such as ourselves makes use of things like arbitrage and alternative investments. We do offer that as extra investments to the standard or to the normal investment house investments. So Kanya, you're welcome to also take my number that I've just given. Contact me. I'll put you in contact with one of my advisors, do a planning session and help you with a proper investment. Okay. Thank you. There we go. I love it when people help me out because I don't get to everybody. Ainley, thank you, Corey. Pleasure, Ainley. Got it from a bio. Great stuff. Thank you very much. Now I've jumped 110 places again. Okay, maybe not that far. Teresa says, so true, Sanlam is a good company. Yes, Teresa. Folks, let me tell you, let me be honest with you. If you go and look at your big insurers, Sanlam, Old Mutual, Liberty, Discovery, Momentum, Allan Gray, Marriott, Coronation, 91, the list goes on. There's a number of them. There is not really any of those that are bad. The bad companies, they normally get sorted out. Sorry, my eyes are burning for some other reason. The bad companies normally get worked out of the system due to bad management. And you normally see it. If a company's management is bad, then their portfolios start doing not so well. And that's when people stop using them. And the snowball effect just kind of works them out of the equation, works them out of the market. So the majority of companies are good. Myself as a financial advisor and every other financial advisor out there will have one or two or even three companies that they prefer to deal with for a variety of reasons. I might not want to deal with company A because I feel their cost is too high. I might not like to deal with company B because I think they're too complicated. I might not like to deal with company C because of this. I myself deal with one company very often, most of the time, Old Mutual, because of the trust I've built up with them over the years. The fact that I've never done an investment with them that has not returned the growth that was expected. The fact that all claims that I've always submitted to them has always been paid. I'm not saying that's the only company I place with, but that's where I put the majority of my business because I have a trust relationship with them. And so every advisor out there will be making use of a specific company. Some guys will be selling Sanlam, some guys will be selling Momentum, other guys will be selling Liberty because they have built up a trust relationship and the products, they understand the products. But these companies would not be out there, would not be surviving if they're not doing good work. So Sanlam is a good company, but really there's a lot of other good companies out there as well. Patricia says, so true, I'm an IFA and Sanlam is one of my preferred companies. You see, can you believe it? I just gave this whole story about companies and then Patricia says that. Patricia, I'm looking for IFAs. Just by the way, I'm looking for IFAs. So if you know people that wants to make a move, I've got a wonderful value proposition. Talk to me. Okay, Mr. Best says, please can you tell me about my birth certificate value at the IMF? Thank you. Huh? Mr. Best, I have no idea what you're talking about. Your birth certificate value at the IMF, I have absolutely no idea what you're talking about. I don't often get questions that I know nothing about, but on yours I know nothing. Unless I'm misunderstanding something here, but I really don't think any birth certificate has any value. And IMF, I'm not sure what IMF is in this relationship. IMF could be a variety of abbreviations. So, Mr. Best, could you please expand, or even better, can you please send me a message on my WhatsApp number? I really, really would like to go and have a look at this and know what it's all about. Philip says, evening stranger. Good evening, Philip. How are you doing? Hold on a second. Philip is Essie. Essie, ek moet nog by jou kom kuier in die Kaap. What do you think of investing your money in an income plan at a company who pays the tax? What do you think of investing your money in an income plan at a company who pays the tax? So Philip, basically, all insurers has income plans, okay? And we are now talking about income plans on both pension funds and on your own money, because you can buy income plans with voluntary cash. So all insurers have income plans. Now here's the thing with regards to income plans. Legislation prescribes that the insurance company has to pay the tax over on your behalf to SARS. So what happens is that when an income plan is done for a client, And there is some technicalities and rules, whatever the case might be. The insurer must pay over the tax to SARS. Now, if the income is below a certain amount and it is the only income that you get, then there's no tax payable, they won't bother with it. But if the income is in a certain bracket, they are going to say to you, sir, madam, you are on a 30% tax rate, we have to get 30% to SARS. And if you say, no, but I don't want to pay that, I want somebody else to pay it, they're going to say to you, well, we can't do it. We can get the tax lower, but then you have to give us a tax directive of, let's say, 18%. We only pay over 18%. So based on what you're saying here, Income Planner, the company who pays the tax, all companies will pay the tax on your behalf to SARS. Okay? But it is your money. It is your income. The tax that's being paid is the tax being deducted from your income being paid over to SARS. If you are saying that companies are paying income plan out to you and they are not paying tax on that income, or they're paying the tax and then they're giving you an income, I'm afraid, sir, that can't work because you are not allowed to do this. It's just legislation. You can't pay, I can't invest money with a company and then they pay the tax or whatever they give to me is tax free. Doesn't work like that. Anything that they pay over to me, there must be proven that taxes has been paid. Same as with capital growth, dividends, etc., etc. So, Philip, I do not think that there's companies like this. And if I'm wrong, please tell me. Let me know which companies you're referring to. Once again, same as with the previous person that asked about that birth certificate thing. I would love to know if I'm wrong. I can only improve my own education by understanding things like this. Odex says, I invested with Liberty and you said it's a bad investment. I did now. I am not happy. I invested with Liberty and you said it's a bad investment. I did now. I'm not happy, Kunai. Odex, I don't know if I told you at any stage that Liberty is bad or it's a bad investment. What I can tell you is when I do planning for a client and the client has a specific investment with a specific company, and I feel, it's my opinion, my professional opinion, that that investment is not a good investment for the client, I will tell you. I don't think this investment is good, and I'll explain to you why I think it's not good. So I would not tell you that Liberty is not a good company. The investment that you did through Liberty, I might say to you, is not a good investment because it's not suitable to you, and a different investment would have been more suitable. So I'm not sure what you're saying here, but I do not agree with you. I have said in the past that Liberty is not one of my favorite companies when it comes to investments. I don't place a lot of investments with them, but they're definitely not a bad company. And the products they have is also not bad. I just don't prefer it. The same as I don't prefer property. Same thing. But what you're saying, yeah, me saying it's not a good investment or a good product, I don't think so. I don't think so. Let's see. MJ Fasaki, do you think the repo rate cuts are a longer term trend? MJ, I cannot really tell you about repo rates in terms of the cuts because I do not delve and explore the economics and the political scene out there. Okay, so let me just put that out there. When I see that repo rates are being cut and I tell people about repo rate cuts and stuff like that, it's based on the information that I gather from the economists and the specialist, investment specialists from the companies that talks to us. And normally I'll wait until I've heard from at least 3 of them the same story before I'm willing to venture out and give it out. If repo cut rates are going to be a longer trend, I really don't know. These days, world economics is so upside down. It's so unpredictable. When I started in the industry way back in the 90s, it was not uncommon for portfolio managers and investment specialists to come and give a talk and to say, our expectation for the next 6 months is this, and our expectation for the next 2 to 3 years is that, and our expectation for the next 5 years is that. Because the world was working, it was basically moving it in the same old fashion. These days, if you listen to these people talking, they will tell you, listen here, we see this could potentially happen, that could potentially happen, and they're willing to venture what could happen next 3 to 6 months. But that's about it. Nobody is willing to give a projection 2 years or 5 years or whatever the case might be. So I won't give an opinion of whether I think it's a longer term trend. Like I say, things are so upside down. I mean, just look at South Africa. When America announced a month or so ago the rates that will be imposed on South Africa, everybody went into a panic stations. Our stock exchange took a dive. The rand went crazy, everything like that. Took 5 days and everything recovered as if nothing had happened. But the one thing that everybody kept on predicting is, because of this rates that's going to be imposed on South Africa, the rand is going to weaken, the rand is going to tank, the rand. What's happened since then? The rand has strengthened and strengthened and strengthened. The rand sitting around about 18 rand to dollar. I think yesterday it was 17 rand 90 to a dollar. I haven't checked it today. So it's just very unpredictable. I tell you one thing, I don't want to be an economist these days. I think they go grey at the age of 25 and they want to retire at the age of 35. So, sorry MJ, I didn't mean to go into such a long rant about it, but it was just an interesting question, and it just gave me the opportunity to tell you and the rest of the people that things are unpredictable these days. The only thing, I tell you folks, the only thing that's predictable is if you decide on an investment strategy. I want to get 9% growth for the next 20 years, or I want to get 12% growth for the next 10 years, or whatever the case might be. If you know what your strategy is and you choose an investment and a portfolio that's aligned with that strategy, chances are very, very, very good that you will reach your goal. That's the one thing that's still predictable. Because of the uncertainty of the world that we're living in, the one thing that portfolio managers can do these days is move a lot quicker to catch up or to stay ahead. And that has caused them to be much more active, in my opinion, on how they run portfolios and more successful. Okay, so let me move on here. Otherwise, I'm not going to get through everybody. KLMK says, Aluma Capital is offering 12.5%, no risk at 30.5% worth rec. What's your thoughts? So I've actually been to Aluma Capital's offices. I've actually sat down with them. I looked at their products. Their portfolios have indeed given this return over the last 10 years. The no risk or guarantees that they talk about, it is guaranteed to a certain extent because they buy guarantees themselves from banks. My thing is, with regards to Aluma Capital, is at the end of the day, they are a venture capital company, meaning they do alternative investments, and a lot of it is in the venture capital space. I think it's good products. I do, however, think the risk is substantially higher than what it is advertised to be. So I do see on the results, the returns, but I do not buy in that it is sustainable for the next 5 years or 10 years or whatever. So my opinion with regards to that is, I think it is a great company with great products that you can use for portions of your capital. But it is definitely not the type of products that I will put all my clients' money in. You have to look at the risk that's associated with the investments. And like I say, my personal opinion is, and I know if somebody from Aluma listens now, they will not agree with me, but my personal opinion is that the risk on their portfolios are higher than what it's made out to be in terms of their marketing. But I'm not going to shoot them down. I have seen some great results from them. Products look good. Okay, I hope that helps. How can a person get a lower tax bracket on a personal funds saving? So Odex, if you are on a 40% tax bracket, for example, investing in an endowment, your endowment, the growth in your endowment will be taxed at 30%. So there you've got a 10% tax saving because in your own personal tax rate is 40%, but your investment growth is only taxed at 30%. Vice versa, if you have a tax rate of 18%, okay, then you will be investing in something like unit trust because your capital growth will be taxed at 18%. If you take out a tax-free plan, the funds that goes into the tax-free plan is not taxed. So there you are saving tax. You're not saving in your personal capacity, but overall in your total person portfolio, you are saving tax and you are bringing your own tax down. You can't see it in the tax bracket, but you are effectively bringing your own tax down. So there's a variety of ways. You can take out a retirement annuity. The tax rebate that you get, if you go and take that tax rebate and you work it into your tax for the year, then you've brought your tax down. So there's a number of ways to do it, a number of investments. Philip says, I'm in a 41% tax bracket. They pay a fixed percentage at 30%. I will WhatsApp you the detail. Philip, please do. Because all I can think of, Philip, is we talked about income plans when we talked about this, the company pays the income tax on your behalf. So all I can think of, Philip, but I want to see it. I still want to see it. If you're on a 41% tax bracket and the company pays a fixed percentage of 30% tax and the rest to you, then you are most probably in an endowment. So if you put money into an endowment, remember, for 5 years it's fixed. Yes, you do have access to it, but it's fixed. All the capital growth that happens within that endowment is taxed at 30%. The capital gains tax is 30%. So that's where you save 11%, just as I told the previous person on investments. Now, if your investment, if this endowment of yours comes to 5 years or later, now you are actually allowed to withdraw funds from that endowment on a regular basis as an income. Now, if that's the case, then you're spot on, because then you've got an endowment where you are now getting an after-tax income on a monthly basis, because it's already been taxed within the endowment and was taxed at that 30% that endowments are taxed at. So if this is what we're talking about, Philip, then yes, 100%, then it's an endowment. But yeah, and the company is, for all intents and purposes, paying the tax on your behalf, and you receive the after-tax income or the tax-free income, and that is what you're getting as a monthly income. Nice thing about something like this is, if you have planned your retirement very well, for example, and you've got X amount in a retirement annuity or pension fund, X amount in endowment, both of them are going to give you an income exactly the same. The one, and let's say both of them is 20,000 Rand a month income, because you've got the retirement annuity or pension fund, you're only paying tax on the 20,000 Rand you get from there. The 20,000 you get from the endowment is after-tax money, tax-free, because it's already been taxed in this fund at this 30% that we're talking about. So effectively, you're getting a 40,000 Rand a month income, only being taxed on 20,000. So you're paying only a quarter of the tax that you should be paying. Lekker. Good financial planning, good investment planning. Folks, I'm running out of time again, and tonight I actually have to go and get documents signed with the lawyer quickly. So I can't stick around too much. I'm going to answer these last questions very quickly. Craig says, I was retrenched. Who would be the best company to invest my pension with? Craig, I think I've said this about 4 or 5 times tonight. I can't really tell you that. I can tell you Old Mutual because I prefer Old Mutual. The next advisor is going to say Sanlam because that's who they prefer. The next oak is going to say Liberty, and so on and so forth. At the end of the day, I think the important thing is for you is that you must take that pension and move it to a preservation fund. And I also do feel that you have to speak to somebody that can advise you on the different companies and the different portfolios. My personal opinion is I will place you with just about any company that you want to go with. I won't even go to my favorite. I'll place you with any company as long as I can structure your preservation fund in such a way, I can structure your pension preservation fund in such a way that you are, or that you have 75% equity in your portfolio and 45% global equity of that. That is the important thing. Then it almost doesn't matter whether you're going to be with whichever company. If the portfolio, the underlying portfolio is structured correctly, that is what you need. So, Craig, when you go and speak to somebody, okay, let them mention whichever company. When they come with a presentation on the portfolio structure, look to see if that's right. If that advisor can't get that right for you and can't do that for you, then it's time to find somebody else that can do it. Because I promise you, it's unfortunately like this. A lot of financial advisors don't know how to do that. They don't know how to structure it right. So make sure that you just get somebody that's going to structure it right for you. Patricia says, it's not depending on which company, just make sure you get good advice. Thank you, Patricia. Appreciate it. Donald Trump is a bang for bricks. Yes, he is. Jesus, please clarify. Okay, MJ Versage says, my Old Mutual Global Equity Fund averages 14% for the past 10 years and charges 3.6% annually. Is it too much? MJ, I suppose it depends on what type of product you have with them. I love the Old Mutual Global Equity Fund. And as a matter of fact, it's not only given 14% for the last 10 years, it's given 14% for the last 21 years. Unreal. One of the best funds out there. At 3.6%, it sounds to me a bit on the high side. But that is going to depend on what the premium is, what the lump sum value is, what the commission and fees is that your advisor is charging you, which product it is that you've got at the moment. Yes, I think you can go or you can get a bit lower fee. They've got this thing that they call family discount. Your advisor, you could negotiate with your advisor to take a lower fee. If they're taking the maximum fee, you can. So you can actually get it lower, MJ. Don't be scared to take it up with your advisor. And if your advisor doesn't want to listen or don't want to help or can't help, well, get a second opinion, sir. Get a second or get a second and a third opinion. And that 14% before charges, that's not quite right, MJ. And the reason why I say it's not quite right is that 14% on their fund fact sheet, that is after the portfolio management fee has come off, okay? So that 14% is after the portfolio management fee, but then you go and look at the underlying cost of the actual product, meaning the admin fee, management fee, and the advice fee. And that is what I was referring to on the 3.6%. That's what I believe that you are looking at, is that underlying product fee is 3.6%. And yes, then I feel it's a bit on the high side. Thank you. Kubomo. Do you know where I can locate Boland Parow Bank? I need a session. Do you know where I can locate a Boland Parow Bank? I need a session to be. No, mate. I don't deal with banks. I really can't help you. What else? Kubomo. Clark, can you assist with the context, please? Okay, you two can help each other out. Chat later, gotta run. It's my league night. Cheerio. I have to go. Hi, sir. When you when you're on pension, you have minor kids, do they qualify for an allowance? Netta, it depends. It depends on what pension fund we talk about. It depends on whether we're talking about death. There's so many variables here with regards to it. But overall, minor kids will only qualify for pension if the parents pass away. And then the trustees will decide on that pension and allowance. D, contact me. I'll put you in contact with one of my advisors and they will do the planning for you and invest the money for you. Okay, folks, thank you very much. 1 minute past 7. Like I say, I have to run tonight. It was fun. From next week, definitely Wednesday nights again. Okay, so see you next week. Keep well.